Imagine convincing one of the world's smartest investors to hand you $47 billion for a company that rents office space. Then imagine cashing out $700 million personally, buying a $60 million private jet, and walking away right before everything collapses. Sounds impossible, right? But that's exactly what Adam Neumann did to Masayoshi Son and SoftBank. In just 6 weeks during the summer of 2019, WeWork went from being valued at $47 billion to $7 billion. Thousands of employees lost their jobs. Investors lost fortunes. And the man responsible? He walked away with a golden parachute worth over $1 billion. This is the story of how a charismatic surfer from Israel convinced the world's most sophisticated investors that leasing office space was actually a revolutionary technology company. How he trademarked the word "we" and sold it back to his own company for nearly $6 million. And how one of the biggest financial frauds of the 21st century unraveled in spectacular fashion when the truth finally came out. You're about to learn exactly how Adam Neumann pulled off the WeWork scam. If you're fascinated by the economic stories you slept through, the billion-dollar disasters, frauds, and scandals that shaped our financial world, hit that like button and subscribe to The Sleeping Economist. Ring the notification bell so you never miss these incredible true stories of greed, deception, and financial collapse. Chapter 1. The Charming Con Artist. Adam Neumann arrived in New York City in 2001 with big dreams and very little money. Born in Israel, raised partly in Indiana, Neumann had something that would prove more valuable than business experience or technical skills. He had charisma, the kind of magnetic personality that made people believe whatever he said, no matter how absurd. Before WeWork, Neumann tried launching a company making baby clothes with built-in knee pads. It failed. He wasn't discouraged. In 2008, he partnered with Miguel McElvey to launch Green Desk, a shared office space in Brooklyn focused on sustainability. The concept worked modestly, but Neumann saw something bigger. He didn't want to run a small real estate business. He wanted to build an empire. In 2010, they sold Green Desk and launched WeWork. The business model was simple. Lease long-term commercial real estate at wholesale prices, divide it into smaller offices and desks, then rent those spaces short-term at retail prices. Add some free beer, modern furniture, and a sense of community. Essentially, WeWork was a real estate arbitrage play dressed up with millennial aesthetics. But here's where Neumann's genius for deception began. He never called WeWork a real estate company. Instead, he branded it as a technology company, a platform, a movement. He talked about elevating the world's consciousness and creating a capitalist kibbutz. These weren't just office spaces, they were physical social networks. The pitch worked brilliantly. Tech companies command much higher valuations than real estate companies because they can scale without proportionally increasing costs. A software company can add 1 million users without building 1 million offices. But WeWork had to lease, build out, and operate every single location physically. The margins were thin. The capital requirements were massive. The business model was fundamentally real estate. Neumann didn't care. He positioned WeWork alongside companies like Facebook and Uber. When investors asked about profitability, he created new metrics. He invented something called community-adjusted EBITDA, essentially profits if you ignored actual costs like building expenses and marketing. Under traditional accounting, WeWork was hemorrhaging money. Under Neumann's creative metrics, it looked like a rocket ship, and investors believed him. Between 2012 and 2014, WeWork raised hundreds of millions from prestigious venture capital firms. Neumann's valuation claims kept growing. 50 million, 500 million, 5 billion. Each funding round brought more believers. Neumann surrounded himself with yes-men, filled his board with friends, and built a corporate culture around his personality. He surfed before important meetings. He walked around barefoot. He preached about consciousness and spirituality while building one of the most ruthless growth at any cost companies in Silicon Valley. The stage was set for the biggest con in modern startup history, and the perfect mark was about to walk through the door. Chapter 2. The perfect mark appears. Masayoshi Son was exactly the kind of investor Adam Neumann needed. The founder and CEO of SoftBank, Son had built a reputation as a visionary who thought bigger than anyone else in tech investing. He'd made an early bet on Alibaba that turned a $20 million investment into over $100 billion. Son didn't do cautious, incremental bets. He swung for the fences. In 2016, Son launched the Vision Fund, the largest technology investment fund in history, at $100 billion, mostly backed by Saudi Arabia's sovereign wealth fund. Son needed big ideas to deploy that capital. He needed transformative companies that could absorb billions in investment. He needed exactly what Adam Neumann was selling. When Neumann and Son met for the first time, magic happened, at least from Neumann's perspective. Son famously made investment decisions based on gut feeling and personal connection with founders. After a 12-minute meeting, Son told Neumann he was crazy, but in a good way. Son said Neumann wasn't thinking big enough. WeWork shouldn't just be about office space. It should be about revolutionizing how people work, live, and interact. This was music to Neumann's ears. Here was an investor encouraging him to be even more grandiose in his vision. In 2017, SoftBank led a $4.4 billion investment in WeWork at a $20 billion valuation. Neumann had found his whale. The relationship between Neumann and Son became dangerously one-sided. Son gave Neumann virtually unlimited capital with minimal oversight. SoftBank kept writing bigger checks. WeWork expanded into WeLive, co-living apartments, WeGrow, a private school, and even discussed WeBank. Neumann talked about becoming the first trillionaire. He compared himself to Steve Jobs and Elon Musk. Behind the scenes, the business fundamentals were deteriorating. WeWork was burning through cash at an astonishing rate, over $1 billion per year. The company kept opening new locations to justify growth metrics, but many existing locations weren't profitable. Long-term leases created massive future obligations, while short-term rental income remained unpredictable. During economic downturns, companies cut office space first. WeWork's model had enormous risk. None of this seemed to matter to Son. In January 2019, SoftBank invested another $2 billion, valuing WeWork at $47 billion. This made WeWork more valuable than established corporations with actual profits. It made Neumann a billionaire on paper, and it set up one of the most spectacular collapses in business history. Because while SoftBank was pumping billions into WeWork, Adam Neumann was personally cashing out. He'd already pulled $700 million out of the company through stock sales and loans against his shares. He was preparing for an outcome very different from the triumphant IPO he promised investors. Whether he knew it consciously or not, Neumann was building his escape plan. Chapter 3. The House of Cards Revealed. In August 2019, WeWork filed paperwork with the Securities and Exchange Commission for its initial public offering. Going public meant WeWork had to disclose detailed financial information and corporate governance practices. For years, Neumann had controlled the narrative about WeWork through press releases, interviews, and private investor presentations. Now, for the first time, independent analysts and public market investors could examine the real numbers. What they found was shocking. The IPO filing revealed that WeWork had lost $1.9 billion in 2018 on revenue of just $1.8 billion. The company wasn't losing money because it was investing in future growth. It was losing money on its core business model. Every new location added to losses. The unit economics simply didn't work. But the financial losses weren't even the most disturbing part. The filing exposed corporate governance practices that ranged from questionable to outrageous. Adam Neumann controlled the company through special supervoting shares that gave him 20 votes per share, while regular investors got just one. He could never be removed as CEO without his consent. Then came the personal conflicts of interest. Neumann owned buildings that he leased back to WeWork. He'd trademarked the word "we" personally, then sold that trademark to WeWork for $5.9 million. WeWork invested in Neumann's side businesses. The company paid rent on a surf pool Neumann wanted built. He'd taken out over $700 million in loans against his WeWork shares, essentially cashing out while still controlling the company. The lifestyle details were equally damaging. Neumann's $60 million private jet, reports of marijuana use on flights, tequila shots before board meetings. His wife Rebecca, who ran WeGrow and had significant influence over hiring and firing decisions, despite having no relevant educational experience. The corporate culture at WeWork headquarters resembled a fraternity more than a serious business. Wall Street analysts began publishing devastating research reports. They called WeWork's valuation absurd. They questioned every aspect of the business model. They compared Neumann unfavorably to fraudsters like Elizabeth Holmes of Tyrannos. The media piled on with investigative pieces revealing even more disturbing details about Neumann's behavior and WeWork's operations. The IPO roadshow, where companies pitched themselves to potential investors, became a disaster. Investors asked pointed questions Neumann couldn't answer satisfactorily. They challenged the valuation. They demanded governance changes. The enthusiasm that greeted WeWork in private markets evaporated completely in the harsh light of public scrutiny. Within weeks, it became clear the IPO couldn't proceed at anything close to the $47 billion valuation SoftBank had assigned. Investment banks suggested trying at $20 billion, then $15 billion, then $10 billion. With each downward revision, the disaster became more apparent. Adam Neumann had convinced private investors to ignore fundamentals and believe his vision. But public markets demanded actual profits, sustainable business models, and proper corporate governance. WeWork had none of those things. The con was falling apart. Chapter 4. The 6-week implosion. Between August and September 2019, WeWork experienced one of the fastest corporate collapses in modern business history. The company went from being valued at $47 billion to facing bankruptcy in just 6 weeks. The implosion happened so quickly that employees, investors, and even Adam Neumann himself seemed stunned by the velocity of the disaster. First came the valuation cuts. As public market interest evaporated, WeWork's bankers kept slashing the potential IPO price. By mid-September, they suggested WeWork might only be worth $10 to $15 billion, less than 1/3 of SoftBank's valuation. This created an enormous problem. WeWork desperately needed capital, but it couldn't raise money at such a drastically reduced price without admitting the previous valuation was fraudulent. Then the business started cracking under pressure. WeWork had expanded aggressively, assuming unlimited access to capital. Now that capital was disappearing. The company had about $2 billion in cash, but was burning through $400 million per quarter. Without new funding, WeWork would run out of money by mid-2020. Landlords and contractors started getting nervous. Some demanded payment up front. Media coverage became relentlessly negative. Investigative journalists published exposes about Neumann's erratic behavior. Former employees spoke anonymously about the toxic culture, the financial recklessness, and Neumann's absolute control over every decision. Each article damaged WeWork's reputation further and made the IPO less viable. SoftBank faced a terrible dilemma. They'd invested over $10 billion in WeWork at the $47 billion valuation. If WeWork collapsed, SoftBank would lose everything. If they invested more money to save WeWork, they'd be throwing good money after bad. Masayoshi Son had been hailed as a visionary for his Alibaba bet. Now he looked like a fool for the WeWork disaster. On September 17, 2019, WeWork officially postponed its IPO indefinitely. This was a polite way of saying the IPO had failed completely. The company couldn't go public because no one wanted to buy shares at any reasonable price. For a company that had raised billions from the world's most sophisticated investors, this was humiliating. But the real shock was still coming. WeWork's board, finally recognizing the magnitude of the crisis, met to discuss removing Adam Neumann as CEO, the man who'd controlled the company with an iron fist, who couldn't be fired without his consent, who'd convinced everyone he was the indispensable visionary behind WeWork's success. That man was about to be pushed out. Except Adam Neumann had one final card to play. He still controlled the voting shares. He could block his own removal. If the board wanted him gone, they'd have to pay for it. And Neumann intended to extract every dollar he could on his way out the door. The scam wasn't over yet. Chapter 5. The Golden Parachute. On September 24, 2019, WeWork announced that Adam Neumann was stepping down as CEO. The press release framed it as Neumann's decision to let professional management take over during a challenging time. The reality was very different. Neumann had been forced out, but he'd negotiated one of the most outrageous exit packages in corporate history. SoftBank, desperate to save their investment and stabilize WeWork, essentially paid Neumann to leave. The package was staggering. SoftBank would buy almost $1 billion worth of Neumann's WeWork shares, pay him a $185 million consulting fee, and extend him $500 million in credit. In total, Neumann would receive roughly $1.7 billion for running a company into the ground. Let that sink in. Adam Neumann had built a company that lost nearly $2 billion in a single year. He'd created toxic corporate governance. He'd enriched himself through conflicts of interest. He'd misled investors about WeWork's fundamentals. And for all of this, he received a golden parachute worth $1.7 billion. Meanwhile, WeWork employees faced mass layoffs. The company announced it would cut 2,400 jobs, about 20% of its workforce. These weren't executives who'd gotten rich on stock options. These were regular employees who believed in Neumann's vision and worked brutal hours to build WeWork. They received severance packages measured in weeks of salary, while Neumann walked away with billions. SoftBank's total losses on WeWork eventually exceeded $10 billion. Masayoshi Son publicly apologized to his investors for the disaster. The Vision Fund's reputation was permanently damaged. But SoftBank's losses were nothing compared to what happened to WeWork's valuation. In October 2019, SoftBank arranged a rescue financing package that valued WeWork at just $7 billion. In less than a year, the company had lost 85% of its value. Investors who'd bought shares at the $47 billion valuation saw their holdings become nearly worthless overnight. The WeWork scandal exposed fundamental problems with startup investing in the 2010s. Venture capitalists had become so focused on disruption and growth at all costs that they'd stopped asking basic questions about profitability and sustainable business models. They'd allowed founders to accumulate unchecked power through special voting structures. They'd accepted new financial metrics that obscured losses. They'd valued storytelling over substance. And Adam Neumann had exploited every one of these weaknesses perfectly. He'd told the story investors wanted to hear, in the language they wanted to hear it, backed by a lifestyle that projected confidence and vision. By the time anyone realized WeWork's foundation was built on sand, Neumann had already cashed out. Chapter 6. The Lessons We Should Have Learned. The WeWork disaster should have changed how investors evaluate startups. It should have ended the practice of giving founders unlimited control through supervoting shares. It should have killed acceptance of made-up financial metrics like community-adjusted EBITDA. It should have made everyone more skeptical of charismatic founders who promised to change the world while enriching themselves. But here's the uncomfortable truth. Not much changed. Yes, some venture capital firms claimed they'd be more careful about corporate governance. Yes, some investors said they'd focus more on unit economics and sustainable growth. But the fundamental dynamics that enabled Neumann's scam remain in place. For regular people trying to understand business and investing, WeWork teaches several crucial lessons. First, when someone creates new financial metrics to measure success, that's a massive red flag. Real businesses use revenue, profits, and cash flow because these numbers can't be manipulated easily. When a company invents metrics like community-adjusted EBITDA, they're trying to hide fundamental problems. Second, extreme concentrations of power lead to abuse. When Adam Neumann controlled WeWork through supervoting shares, no one could stop him from self-dealing, making terrible decisions, or creating a toxic culture. Healthy organizations have checks and balances. When one person has absolute power, disaster usually follows. Third, lifestyle and personality matter. Neumann's erratic behavior, substance use, and grandiose statements weren't irrelevant personal quirks. They were warning signs about judgment, priorities, and character. When someone running a company acts like a rock star instead of a responsible executive, that company is probably in trouble. Fourth, business model fundamentals can't be ignored forever. WeWork's unit economics never worked. The company lost money on every location when properly accounting for costs. No amount of charisma or growth could change that basic fact. Eventually, reality catches up with fantasy. Finally, the person at the top almost never pays the price for disaster. Adam Neumann walked away with over $1.7 billion. Employees lost their jobs. Investors lost fortunes. But the man responsible for the entire mess got richer than ever. In November 2023, WeWork filed for bankruptcy. The company that was once valued at $47 billion couldn't survive. The physical locations still exist. The employees still lost their jobs. The investors still lost their money. But Adam Neumann is a billionaire, free to start his next venture, find his next mark, and perhaps pull off his next scam. That's the WeWork story. That's the disaster that fooled SoftBank. If stories like this, where we uncover the economic events that shaped our world while most people weren't paying attention, fascinate you, please like this video and subscribe to the channel, because we're just getting started with these financial, educational mysteries.